We're going to talk about the concept of an exempt policy versus a non-exempt policy. This is still part of Chapter 7, where we're looking at taxation of life insurance policies. And exempt and non-exempt, that concept came about again at that same date that tax changes were made, December 1st, 1982. And for the most part, an exempt policy is a policy where the primary objective of the policy is to provide insurance coverage. Okay? A non-exempt policy is a type of policy where the client's primarily interested in accumulating savings under the policy. And in fact, you are under the law able to accumulate savings, tax shelter those savings up to a certain level, but if you are over that level, that policy is no longer deemed to be an exempt policy. So an exempt policy is simply a policy whose primary focus is to provide insurance coverage. Doesn't mean it cannot have cash value. It can have cash value, but only up to a certain level. A non-exempt policy is a policy that Revenue Canada says this looks more like an investment. And because it's like an investment, anytime the cash value goes up each year, it increases in value, we are going to tax that increase each year. So a non-exempt policy, primary objective is investment. Any increases in the cash value each year, the client must pay the tax just as if it was an outside investment. If you bought a GIC and it was paying you 4% interest, every year you're going to have to pay tax on that 4% interest. Same if your policy is deemed to be a non-exempt policy, any increase in the cash value, you're going to have to settle your tax each year. So, prior to December 2nd, 1982, there was no such distinction between an exempt and non-exempt policy. In fact, all policies were exempt. After December 1st, 1982, the new rule came into place, and in fact now we have to test the policies to see if they are exempt or not exempt. Okay? So there are two tests available or mandatory under the Income Tax Act. First is called the Maximum Tax Actuarial Reserve Rule, and the second one is the Anti-Dump-In Rule. So let's spend a few minutes on these two exempt tests. A lot of your questions, or quite a few of the questions under your licensing exam, will in fact test you on your understanding of these two concepts. So I am now going to go to the board and we're going to explain the MTAR line. In our discussion about taxation of insurance policies, we introduced the concept of an exempt policy versus a non-exempt policy. We talked about policies, the primary objective being insurance, versus some policies where their primary objective is in fact to accumulate savings. And we also talked about the significant advantage of life insurance policies is that if you have a permanent plan and you're building savings under that plan, the increase in value each year of the earnings in the plan are actually tax sheltered. You do not have to pay any tax on that increase in value each year. So if we look again at this diagram, which represents a permanent insurance policy, you can see here I've got a person age 40 owning a policy, and at the end, age 100, this is a picture of the entire 60-year life cycle of that policy. It's a $100,000 death benefit. And as the policy is accumulating earnings and savings, it, as it stands, is not being subject to any tax. So in other words, the increase every year in this value is tax sheltered. If in fact the client had taken that same money and put it into a bank deposit or a GIC or some other type of investment, the increase every year would be subject to tax. just as if it was an outside investment. And so there is an advantage with life insurance policies in that we are able to tax shelter growth within the policy and not having to settle tax every year. Now this is the scenario, used to be like that years and years ago, and in fact some people used to put a lot of cash in here and in fact didn't have to report any tax on the earnings. Back in 1982, the federal government changed its position on this, and they said it's okay if you can accumulate certain savings in your plan, but you can't go crazy, you can't go wild. And in fact, they introduced this line called a tax reserve line. It's referred to as the MTAR line, maximum tax actuarial reserve line. And so when they introduced this line, what they basically said is if your life insurance policy accumulates account value, as long as your account value is below this test line, this tax actuarial line, your policy will be treated as if it's insurance. And in fact, any increases in these savings in your plan, you're not going to have to pay any tax as they increase. However, if for some reason you put too much money into the plan or your returns are beyond what you expected, and in fact your account value starts to exceed this line. So now my account value is starting to grow over here. So Revenue Canada would say, aha, wait a minute, there's too much money sheltered under the account. This doesn't look a lot like insurance anymore, looks like an investment, and therefore we are going to now start taxing this policy as if it was an outside investment. And so if the the account value goes over this line, we say the policy is now non-exempt. What that means is that it is no longer exempt from annual taxation. If the values remain under this line, the policy is said to be exempt. So it's exempt from annual taxation. Now a lot of students will get these two terms confused. Be clear. If the policy is exempt, it means there's no annual tax reporting. If it is in fact non-exempt, your client will have to pay tax every time on the increase of these values. And so insurance companies, in fact, track this, and they notify clients to say, hey, you're getting too much cash in the account. Your policy could, in fact, become non-exempt, and therefore you're going to have to pay tax on the accumulation each year. And so they give you certain options. Certain options might be remove some money. Another one might be don't send any more premiums this year, because we're going to try and make changes to make sure your policy remains as an exempt policy, not subject to annual tax accumulation and accrual tax on the accumulation every year. So this concept of exempt, non-exempt is important for you to understand because it defines policies as are they going to be treated from a tax standpoint as an insurance policy, or are they going to be treated as an investment policy? So, as a review, maximum tax actuarial reserve line, which we just covered, it's that benchmark which against all policies are tested. And there are changes again made in December 1st, 2016 as to how to calculate that tax reserve line. You don't need to know how to calculate it. You just need to know what the MTAR amount is, and insurance companies will in fact provide you with that. Each policy has its own. It's tracked by the insurance company, and if in fact one of your clients happens to have too much cash in the account, in fact it's gone over the line, there are certain remedies that are available. He's not going to be taxed right away. He's given 60 days to resolve the issue. And usually what happens is insurance companies automatically will increase the death benefit so that the new death benefit, in fact, relative to the cash value, it now becomes exempt, or the client can always go in and take some cash out. Because the goal here is to try and keep your policy exempt so you don't have to pay tax every year on the increase in value. Now, the second test, which is called the anti-dump-in rule, this stops policyholders from making large lump sum deposits into a plan after policy year 7. So if you think about this, if I had a policy, a universal life policy, and I was paying the minimum premium, I just basically have primarily term coverage with very little cash in there, and then I decide, aha, I got a bonus, or I won some money in the lottery, or I got an inheritance. I want to dump a bunch of money into this insurance policy because I'm going to be able to shelter any taxation from the increases in the cash value in that policy. Revenue Canada said, yes, you can do that, but we are going to limit how much you can dump into that policy. And so beginning in the 10th policy anniversary, they will look at the cash value 3 years before and say you can only put in up to 2.5 times what was there in year 10. In year 11, you can only put in up to 2.5 times what was there in year 8. In year 12, 2.5 times of what was there in year 9. So that anti-dump-in rule is that second rule that's there to make sure policies are exempt or non-exempt.